What's up guys, Mike Sharp here. This is Sharp Investing and I am getting a PDD video done. I have not done many videos, I apologize. This year has been really busy for me and I hope to get to more videos soon. But here's a PDD video for you. It's been in a way boring since I purchased PDD back, I think it was May last year. And they've basically just been running the table on everybody for that time. And they've had, some incredible results. I haven't really done videos on it. It's just beat after beat. And the management doesn't really say anything of interest or value. They're just sort of these high level, really vague statements. And, so there's not a lot to glean from it. They've just been doing great. And this quarter was really interesting because the stock got destroyed after earnings. And I want to go through and discuss whether I think that's a legitimate beatdown or if this is creating an opportunity for us. Okay, so let's just look at the numbers first. I'm going to pull up here. So again, a great quarter, right? We're up to what, 13.3 billion in revenues. The adjusted net income was 4.7 billion at about $3 per share. So they're running at about a $12 a year earnings clip right now, which as I'm looking at the stock, it's what, 93.30 as of today. And so that's less than an 8 price to earnings ratio on forward earnings if growth stays flat from here. So it's looking pretty good at this price just from that perspective. One of the things that's happening here is they're just building up a huge pile of cash, right? They've got now 46 billion in net cash, which puts the enterprise value at what, 83, I think, something like that. It's about a third of the market cap is now in cash, which is crazy. So if you do an EV, enterprise value to projected earnings of, let's say they're going to make 16 billion, like that's probably a low estimate this year, but even if they make 16 billion and enterprise value is at 83, you can do the math. That's a very low number. Maybe I can't really do the math. What is that, about 6, 5? So just over 5 price to enterprise value if you deduct the net cash. So it's pretty cheap now, however you cut it. Even if you look on a trailing 12-month basis, it's still a pretty good deal. I personally believe that earnings from the second half of last year are not that relevant now, just because there's been so much growth in the meantime. I think it's more like about figuring out what the numbers are going forward. And unfortunately, PDD doesn't give us very much information to be able to figure that out. So actually, before we go into the management comments, I wanted to put up an image here from a couple of images from Hayden Capital, who does pretty good reporting. And their initial investment thesis was the thing that got me going on PDD. But right now they are estimating that Temu Grocery is now profitable, right? So that's a big shift, right? Because they've been investing in this for quite a while now, and this is a huge arm for them. So Hayden Capital actually estimates that they are profitable now on Temu Grocery, which is a big deal. At the same time, they're also estimating through their Bernstein research image that they put here that the US is now profitable in Temu as well, which is another huge event. So they don't have any big, well, other than their international Temu arm, there's no real big investment processes happening right now. And almost everything is contributing to the bottom line. And that's why I think we're seeing such huge margins, right? They're running at a 33% net margin, which is unbelievably good. And it almost makes me think, every time I look at these numbers, I think this can't be real, right? It's just too good, right? The growth is so huge, even on such a big base, and the profitability is so big. Like, either of these guys are on the path to being the best retail business on the planet, or it's a scam, right? And I still don't know the answer to that, but there's no real good information saying it is a scam, other than speculation, about, oh, they don't have a CFO and stuff like that. But there's nothing really tangible. So anyway, I continue to hold this. But if we go into the thing that I think was problematic here, with the, well, not think, but we know what's problematic. So if I read the management comments, we're seeing many new challenges ahead, from changing consumer demand, intensifying competition, and uncertainty in global environment. As a result, we will enter a new phase of high quality development that calls for increased investment, and our profitability will be affected, will affect it as a result. Okay, so they're telling us they're not going to make as much money going forward. Now, the thing that we don't know is we don't know if that means profitability is going to go down, like the margins are going to decrease from $3 a share, or if it just means the expansion of the profitability is going to stop and sort of reverse. Maybe they'll get lower margins, but they'll still have higher absolute profits because revenue is growing. Like, I don't think revenue is going to stop growing from here. So, that's a question. There were some comments about merchants that were throwing a hissy fit and protesting outside their Temu offices because they weren't making any money. Apparently these were low quality merchants, who knows, right? But what they've done is they are actually taking 10 billion won and they're going to reinvest that into reducing transaction fees for their merchants. Now, it's important to remember that the transaction fees on Pinduoduo in China, the goods side, they're very low already. They're, I think, 0.6%, and that's just to cover the processing of the transactions. So I don't think that that's where they're going to cut the fees. It might be on Temu and maybe on the grocery side. So because they do make margins on transactions on those two products. So but 10 billion won, that's nothing for them. This is a drop in the bucket. That's what, $1.5 billion, which is less than 10% of their net income. So if they're going to invest in their merchants, and they keep mentioning, like, somebody told me that how many times they said high quality in this report. I forget the number, but it's an absurdly high number. So it sounds like they're going to go after the people selling the junk on the platform with crap that people don't like and they're complaining about and stuff like that. And you could argue that that's actually good for the business, right? And so the market reaction, I think, is as a result of not really knowing what they mean by profits going to come down from here, and we can't expect this level of growth anymore. So I think it may make sense to go into the efficient market hypothesis here for a minute. So basically, that we all know what that is. Basically, that the current price is the correct price. Everybody's using all the information to basically come up with the correct value, fair value for a company at any point in time. Now, the one thing, there's many problems with the efficient market hypothesis, but one of them is that has to do with time frames, right? So every market participant has a different time frame, right? So the current fair value can be different if you're looking over a 6-month period or a 1-year period or a 10-year period, right? So if you do any kind of calculation, you're going to get a different number, right? And so the current stock price is a blended average of all those different time frames. And so it's not, I guess what I'm saying is, as we probably know, that most transactions in the stock market are based on people with a time frame of, let's say, 1 year or less, right? A lot of the time, us as value investors will say, the value. Just think unconsciously that this is a price that's derived from value investor calculations. Well, it's not always, right? Because if you think about it just logically, a long-term investor, long-term value investor, somebody with a 5, 6, 10-year time frame, well, they're not actually trading very much, right? Trading, and also this is a group of people that makes up a very small portion of the market versus the people who are shorter-term traders in and out all the time. So they're not having, so the longer-term view, people with longer-term view, they don't really set this price, I don't think. So maybe the 90, what is it, 93.30 right now? Maybe that's a fair market price if you have a 1 year or less time frame, right? Because there's all this unknown now. There's all this sort of risk in there. It needs a risk premium. What does management mean? You know, maybe the earnings will come down by 50% by the end of a year. Maybe we'll only be at $1.50 a quarter in a year from now, and this price maybe makes more sense at that earnings rate. But alternatively, we could be at $5 a quarter. So there's this unknown amount, this unknown variable that's creating fear and creating a risk premium in the stock. That's what I think. But as long-term investors, one of the biggest advantages we can have is looking even just a little bit further out than the market, right? If I'm looking 2 years and ideally 3 or more, you can start getting a big advantage on, you could potentially get a big advantage on a lot of market participants, or maybe not advantage on them, but it can create opportunities where the market's pricing for 1 year and you just look a bit further out. So as small investors, as small retail investors, that's one of the biggest advantages we have. So the question is, do you think PDD, Pinduoduo, is going to be a better business in 3 years? You know, are earnings going to be up, or revenue is going to keep going up, or are they going to be able to improve the quality of their platform? All this kind of stuff. So that's the kind of questions we need to answer. Now, I want to use my wife as an example here. Now, keep in mind, this is a sample size of one, so don't do anything with it. And also, remember, this is not investment advice. This is just me and my thinking about the stocks that I may buy or sell. And you know, you need to do your own work. This is just educational or to maybe complement your own research. So my wife, the story about my wife is that she uses Temu, and I use her as sort of a gauge on the platform, right? So Temu is crap, right? There's a lot of crap on there, and it's cheap. It's dirt cheap. And so the way she uses it is she'll let's say buy 4 things, and her expectation is that 2 of them are going to be garbage and she's just going to throw them away. But the thing is, it's so cheap that you can order 4 things, and even if 2 of them are good, it's still cheap for those 2 items. So that's how she uses this product. And if Temu is successful, or not Temu, PDD is successful at increasing the quality of their platforms, then maybe my wife orders 4 things and she gets 3 that are good, in a year or something. Well, what's going to happen? She's going to order more, right? Because the effective cost per item has actually gone down, because now she's getting 3 for the price of what she used to pay for 2 net items, right? So I would say that investing in getting away from the sort of PDD as this cheap junk sort of like company, I think that's beneficial in the long term. And I do think that they still have, these major advantages over the competition that I will get into right now. Okay, so one of the things that we could maybe guess from this earnings release is that PDD is now going to war, right? They see that competition has ramped up. They talked about competition a few times, and well, what are they going to do, right? So they are looks like they could potentially be preemptively going to war and putting the boots to all the competition. Now, if you've seen my original video where I talk about why I think this is a scaled economy shared business, then we can think about, what does that mean in this context, right? So a business that is the low cost producer, they have the scaled economies model, they have the price advantage, right? And PDD with 33% net margins, they have the low cost producer, and they also have this huge amount of cash flow to work with, plus 46 billion on the balance sheet. So if one of the ideas behind a scaled economy business like Costco, let's say, is if they go to war with you on price, you will lose, right? It just ends up hurting you, because you can't compete with them on price. They just lower the bars, and you have to lower the bar and you eat it, and they just, you know, take less profit for a short period of time while you're hemorrhaging cash, right? And I think that's possible. That's what they're doing here. They're just flexing their scaled economies muscle here. And then just a reminder, the shared part of the scaled economy shared is they take that advantage and they reinvest it back in the customer, and that's the sales and marketing on the income statement, where, you know, if you go on, like, I assume most of us are in Western countries. If you look at Temu, they're basically just giving you, discounts, like, from the company, not from the merchant. The company just gives you discounts on top of the cheap price that the merchant offers. And that's in the sales and marketing expense. So they're taking their profit and recycling it back into the customer to make it even cheaper, and just, again, put the boots to the competition, because that's very, very hard to deal with. So yeah, if you haven't watched that, I suggest going back and watching that video. It gives you a better overview of you know, why this business has a fairly deep moat around it. So I guess my last comment here would be, you know, if we're long-term investors, and I like to put myself in the shoes of sort of a permanent investor. Let's say this is a private company and I own it. Let's say maybe I'm even running it. Well, what do you want to be doing in this situation? Let's say you're planning on owning it for 10 years. Alibaba is taking a run at you. There's some others taking a run at you too. Well, for me, the best thing that I could do as a business would be to defend my turf and say, Alibaba, fuck off. This is my stuff. Hands off. Go somewhere else to make, you know, to try and make money, right? And go in, like, if you want to come here, you're going to be in a price war, right? Basically to scare people away from competing with you on your turf. Right. And so as a business owner, I do think that that's good. Short term, the profitability might be worse, but I think that's the right move from a long-term perspective. Now, Wall Street just wants to milk these fat cows and then just milk them dry till they die, and then they can go somewhere else. Right. But the question is, are you a long-term investor, or are you a short-term trader? You know, maybe you want to avoid this if you're a short-term trader. Just an idea. For me, I'm thinking longer term. I more have a 3 to 5 year window, and I think that in that time frame, it's going to start looking really good. Incidentally, they did actually make an announcement like this about 3 years ago, that they were going to invest more in the platform to expect profitability to come down, and you can see what's actually happened since then. So there is, you know, there's some question as to, is this actually going to be bad or not? And you know, it's possible that, you know, earnings just continue to go up. Maybe not at the same rate, but that they just continue to tick higher and everything looks great in the next couple of quarters. So last thing, I bought 20% more. Added 20% to my position after this drop, around 95, I think. And if it goes lower, I'll probably add more. So again, not investment advice, but thanks for watching if you got this far, and I'll catch you in the next video.